As a business owner, you should have at least a basic understanding of accounting. In particular, you should know how to read your financial statements to better understand your business's performance at the high level. Financial statements are used by creditors and investors in determining if they're going to provide you with capital. Also, comparing one year's financial statements to another year can be useful in judging your overall trajectory of your business. I'm Gabriel Velez, partner at Tehrani Velez, and we're a tax and accounting firm based out of Irvine, California. In this three-part video, I'm going to explain two of the most common bases of preparing financial statements. A basis of accounting is the rules under which transactions are recorded. I also will be explaining what goes on in each of the three financial statements and give some insight on how to read them. So let's get into it. There are two primary bases of accounting. The first is the accrual basis of accounting that records revenues when earned, like a service being rendered or a product being delivered, and records expenses when incurred, when a service or product is received. The second basis of accounting is the cash basis of accounting that records revenues when cash is actually received and expenses when a disbursement is actually made. True cash basis of accounting isn't very common for a business because there are times when it's not appropriate to expense an item, such as when you buy a piece of equipment or real estate that will provide benefit to your business for multiple years, or when you're making a retirement contribution after a tax year has closed. More common is the modified cash basis of accounting that uses cash basis rules for most items, but allows us to use the accrual basis of accounting for certain accounts or items. There are three basic financial statements, and they can sometimes go by varying names, but those financial statements are the balance sheet, which is a representation of your business at a point in time. The next financial statement is the income statement, sometimes referred to as the profit and loss, or P&L for short, which is a representation of your business over a period of time. An income statement related to the balance sheet I just mentioned would be dated January 1st, 2018 through December 31st, 2018. This spans 1 year's time. Finally, the statement of cash flows is similar to the income statement in that it spans a period of time, but instead of judging the performance of a business, it shows us where cash is coming from, inflow, and where cash is going to, outflow. The statement of cash flows can sometimes be difficult for non-accountants to read or grasp, but it's important nevertheless. I'll go into more detail in part 3 of this presentation. Before you can begin to analyze your financial statements, you first have to understand the rules or methodology by which they've been prepared. We call this methodology an accounting basis, and in general we have two accounting bases, the accrual basis of accounting and the cash basis of accounting. Even within these two methodologies, there's a lot of wiggle room or subjectiveness. In order to try and solve the problems that come with subjectiveness, certain authoritative and governing bodies create frameworks and standards. For instance, in the US, public companies are required to issue financial statements using GAAP, which stands for Generally Accepted Accounting Principles. GAAP standards are built around the accrual basis methodology. Conversely, most small businesses file their taxes using the modified cash basis of accounting using tax basis standards. In general, the accrual basis of accounting provides us, as interested parties, with a lot more information than the cash basis of accounting. That's because it doesn't just show us cash received and dispersed, it tries to show us actual performance. Revenues, for instance, are recorded when they're earned rather than when they're collected. Likewise, expenses are recorded when incurred rather than when they're paid. Most standards surrounding the accrual basis of accounting also use the matching principle. The matching principle makes it so you have to record expenses that are directly or indirectly related to your revenue in the same period as that revenue. The end result is a more reliable and consistent profit margin. If you're a non-accountant, chances are you're thoroughly confused right about now. That's okay, stick with me because I'm going to explain it in a more practical sense, showing you what a set of accrual books or financial statements has in it that a set of cash basis financials do not. Functionally, accrual basis financial statements have accrual accounts and deferment accounts on their balance sheet. An accrual is something that has been recorded before cash has exchanged hands. An example would be accounts receivable, or AR for short. The AR account holds money that is owed to me. When I record revenue on an invoice, my AR account increases because my client owes me that money. When my invoice is paid, my AR account decreases because that money is no longer owed to me. While this is occurring on the balance sheet, I have already recorded that revenue on my income statement at the time it was earned. Similarly, accounts payable, AP, increases when I record an expense and owe my vendor money. AP will then decrease when I pay my bill. A deferment is the opposite of an accrual. A deferment is when I recognize the transaction after cash has exchanged hands. Example of deferments are prepaid expenses and unearned revenue. I hold transactions in those accounts until a future date when it is appropriate to recognize the expense or the revenue. It might sound like there's a lot of room to manipulate earnings by using accruals and deferments, because there is. And that's why there are extensive standards and frameworks outlining when it is and isn't appropriate to accrue or defer something. For all intents and purposes, the cash basis of accounting is a much simpler basis of accounting than accrual. On cash basis, you record revenues when you receive money from your clients, and you record expenses when you pay your vendors. Very simple. However, cash basis of accounting is less transparent than accrual accounting because, for instance, if I wanted to overstate my income, all I would have to do is hold off on paying my bills. And that's not good for interested parties like a bank or an investor because they want to know what you owe your vendors and they want to know what your true profits are. That being said, the modified cash basis of accounting is popular amongst small business owners because small business owners would prefer not to ever be in a situation where they have to pay tax on cash they haven't yet received. In practice, taxpayers typically use a modified cash basis of accounting. The difference between true cash basis accounting and modified cash basis accounting is that modified cash basis accounting allows you to include certain accruals. Common accruals relate to things like long-term fixed assets, also called property, plant, and equipment, long-term and short-term debt, tax liabilities, especially sales tax or payroll tax, and employee benefits like retirement contributions. Businesses reporting on the modified cash basis do not include accounts receivable or accounts payable on their financial statements. It's important to understand the distinction between cash and accrual because it'll properly frame the way you need to, the way you look at financial statements. I often look at a client's financial statements that were prepared by an outside bookkeeper and notice an AR or an AP balance, sometimes even a negative balance. And the financial statements are supposed to be on cash basis. That's a red flag for me, and more often than not, the financials aren't accurate. There are three major financial statements: the balance sheet, the income statement, sometimes referred to as the profit and loss, and the statement of cash flows. A fourth financial statement, the statement of shareholders' equity, isn't regularly prepared for small businesses because there usually aren't multiple classes of shareholders, and unrealized gains and losses typically aren't tracked. So the statement of shareholders' equity is basically an addendum to the balance sheet anyways. The purpose of financial statements is to report financial data to interested parties in a concise and uniform way. Interested parties include lenders, investors, shareholders, management, and anyone else who needs to know how business is doing. The first financial statement, and probably the most telling, is the balance sheet. The balance sheet's job is to show a company's financial position on a specific date. And as the name implies, the balance sheet must balance. In order to balance, the balance sheet follows the accounting equation: assets equal liabilities plus equity. An asset is a resource with economic value that your company owns or controls and that will provide future benefit. Another way to put this is that an asset is anything that your company has or that is owed to it. Examples of assets include cash, accounts receivable, inventory, fixed assets, and investments held. A liability is the opposite, something your company owes to another party. Examples of liabilities include accounts payable and any debts owed. Equity is the net assets attributable to owners. Examples of equity include things like common stock, additional paid-in capital, and retained earnings. Retained earnings is just an accumulation account of prior year's earnings. Here's a common format for a balance sheet. Assets are typically shown first and in order of liquidity. Liquidity is how easily something can be converted into cash. Assets are then summed up so they can be compared to liabilities plus equity. Sometimes you'll have subcategories like current assets and non-current assets, each with their own sum balances, but you'll always have a total assets line. Liabilities are shown next, typically shown in order of due date. Similar to assets, you can have subcategories like short-term liabilities and long-term liabilities. Finally, you have the equity section. The next financial statement we'll be talking about is the income statement, or sometimes it's referred to as the profit and loss, or P&L for short. The income statement's job is to show a company's performance over a period of time, such as for the calendar year ended December 31st, 2018, which means January 1st, 2018, all the way through December 31st, 2018. In its simplest form, the income statement can be summarized as revenues minus expenses equals net income, or income minus expenses equals net income. An income statement can have multiple tiers. For example, in QuickBooks, P&Ls are allowed 3 tiers. Revenue minus cost of goods sold equals gross profit minus expenses equals net ordinary income, and then other income minus other expenses equals net other income. And finally, you get your result, net income, by taking net ordinary income minus net other income. Finally, the statement of cash flows. The statement of cash flows job is to show where cash is going to and where cash is coming from. The statement of cash flows is often overlooked, but it does provide a lot of insight, particularly when paired with an accrual set of financial statements. The statement of cash flows is broken down into 3 categories. First category, adjustments to cash from operations. In this category, you'll find things like AR, AP, inventory, and most other things that relate to operations. Next is net cash from investing activities. In this category, you'll find things like the purchase or sale of fixed assets, another business, or securities. Finally, net cash from financing activities category will contain most cash going to or from creditors, investors, and owners. The statement of cash flows bridges the gap between the income statement and balance sheet. It can provide a lot of insight because sometimes a company can be really profitable but not good at generating cash. And other times a company generates a lot of cash but doesn't see the impending doom because their cash flow is unsustainable. Hey everybody, thank you so much for watching our video. If your business is in the greater Orange County or Los Angeles areas and you're looking for a tax and accounting firm that truly understands small to medium-sized businesses, please give our office a call. Otherwise, if you just like our content, please like, share, subscribe, or comment. Thanks again and have a profitable day.